overall, we'd say, you look across the risks, you look across the growth trajectory and earnings trajectory, and we don't think that's priced into U.S. markets in particular right now. The U.S. is trading 18 times. That's typically associated with robust growth in earnings, and we see something of a contraction, maybe a 5% contraction in earnings. So for us, the U.S. market, the major indices, are probably the least attractive market right now.
You're not too keen on the U.S. equity market. Where would you suggest investors put their money?
Well, the growth, the strength for growth is coming out of Asia. It's coming out of China. And so we're looking at emerging markets in particular, where we see better valuations, better response to growth regions, and also some strength from commodities, which we also like. And then I think the read across is to the Asian consumer. Now that pandemic restrictions have been lifted, there's a read across to maybe European consumer names and also early sector companies like in Germany that can benefit from a recovery in Asia.
Mark, one thing that really jumped out to me in your note is you say that you've started positioning for dollar weakness. I think it's interesting in the context of other people also coming out yesterday. Druckenmiller also saying that his number one trade at the moment is shorting the U.S. dollar. What is the thesis for that? Because U.S. interest rates are still pretty high, and many people we talk to think that anticipating rate cuts later on this year is perhaps, again, a little preemptive. So what is the premise for U.S. dollar weakness from here onwards?
Well, thank you. It is a great question, and you're absolutely right that we think that it's premature to anticipate U.S. rate cuts. But the other side of that trade is, what's going on with the other central banks. And we would note that in Europe, inflation is probably further away from being under control. And so that, the ECB could be in a situation where it continues its hiking path much further than the Fed. We think the Fed is closer to the end of its hiking path, closer to a pause, much closer than the ECB. Then also, Japan has had its negative rate policy for some time, and there have been a lot of careers wrecked on the shoals of betting that Japan would start to take some moves. But we're getting more interested there, and we actually think that the potential for the yen to rise in value versus the dollar has increased enough that we want to be positioned there as well.